Now, look, this concept of a balanced portfolio, this is nothing new. Okay, its precedence it has been set in many studies. Welcome to another edition of Financial Fitness Friday. Thanks for joining me. Today is Friday, July 22nd, and today we're going to hop right into it because we're going to talk about why bonds should be included in a well-diversified portfolio. Now, look, this concept of a balanced portfolio, this is nothing new, okay? Its precedence it has been set in many studies of the risk versus reward calculations based on historic data. When some investment categories are weak, others are strong. When some categories of securities are volatile, others are less so. So in order to, in an effort to maximize the return while minimizing risk, a more balanced or diverse portfolio can be the answer. Now, the focus on a balanced portfolio in recent years has been overshadowed by the tremendous gains in the stock market. So any form of diversification has usually taken place by diversifying among small cap stocks, mid cap stocks, and large cap stocks, but all stocks, right? Or maybe balancing those stock holdings across different categories or sectors like tech, healthcare, consumer staples, or energy. Now, there were still really good rewards to be had from simply diversifying across this broad category of stocks. Although this approach provides no hedge in the event of a bear market or of a market correction, exactly like we are experiencing right now, as we all know too well. And this is why true diversity within a portfolio, it has to include a mixture of asset classes. Now, many investors have been very, very stock heavy in recent years. And I feel like the only factor that's dissuaded some investors from going all stock during this market rally has simply been their age or maybe their time horizon, with many older investors hedging their risk a little bit as they approach retirement. For those investors and even for others, there has been no better time in the past decade to diversify than right now. With some of the biggest increases in the Fed's benchmark interest rate and the big pullback in stocks, the attractiveness of bonds have reemerged. So let's talk about bonds as an asset category. You see, increasing interest rates and inflation combined with a falling stock market have reminded all investors that bonds do have a place within a diversified portfolio. Now, this decision probably should include some guidance from a licensed investment advisor like myself, since price and duration decisions can help you to decrease risk. Also, some lower rated bonds might present a buying opportunity, but there is also the additional risk that these investments carry with them when there's a potential recession that looms ahead, exactly like we have right now, right? So in the case of better quality bonds, there is the possibility for utilizing them as a hedge in a recessionary environment, like we're seeing right now, where interest rates continue to rise. Now, of course, there's also U.S. Treasury bonds that can provide income, municipal bonds that can provide tax benefits. There is investment grade corporate bonds. They can provide income and a lower risk of default. Now, that default risk is still higher than the default risk of government bonds. So the corporate bonds will generally offer higher yields. But investors, at least in the current environment, should stick with shorter term bonds and higher rated bonds while these interest rates continue to rise. While the higher rated corporates are attractive to most investors, those bonds with a lower rating, let's say double B or less, they may provide a better yield in order to make up for their higher risk profile. These high yield bonds are riskier, especially when the economy is slowing and when interest rates are rising, like right now. So investors, they don't have to rely only on individual bonds, though. There are ETFs, which can provide diversified exposure to investment grade bonds, government bonds, and even international dollar denominated bonds. So in conclusion, I want to wrap up with saying in a rising interest rate environment, a diverse portfolio that includes high quality bonds or bond funds can provide a really good hedge against volatility and against equity pullbacks. So that's kind of where I want to wrap up today. So I encourage you to take this message to review your portfolio, review your risk tolerance and your long-term goals, and make the decisions that feel right to you based on all of those factors. And I know for many people that can be very, very overwhelming. So I am here to help. So if you receive this video via email, all you have to do is click reply. Send me a short message letting me know that you want to meet. If you're seeing this video on a social media platform, like YouTube or Facebook, all you have to do is direct message me or even comment below, drop a comment below this video. Share your thoughts with me. Let me know that you want to speak about this. I am a licensed fiduciary investment advisor. I'm happy to help. I do this for a living. I absolutely love helping people. So that's going to wrap it up for today's Financial Fitness Friday. Hope you have a great day and a wonderful weekend. All right. Thanks. Take care.